Okay, good morning, everybody, and welcome to another episode of Environmental Social Justice. Today we have a very special guest, Mr. Evan Harvey of Nasdaq. I am personally super excited for this one because I've been talking quite a bit about finance lately, and specifically on greenwashing, which I call unintentional greenwashing, simply because we have this whole new industry that's starting up. Everyone's now focused on the environment, but not necessarily everyone's an expert in the environment. So Evan, welcome. Please tell me what you're working on and everything that's important to you right now.
Well, wow, and we're going to get that in 30 minutes.
We can do two episodes for you.
Thank you for inviting me. Pleasure to be here. So in my role at Nasdaq, I've been in the exchange forever, but in this role for about 10 years, and it's an internal and external role. So it's everything we do at the exchange internally as a public company, as a good corporate citizen, to manage our own ESG strategy, our efficiency, our pathways, our partnerships, and then also externally acting as a liaison from the exchange space out to lots of different frameworks and ESG reporting initiatives like the GRI and SASB and others, trying to represent all companies generally, but really specifically the small and medium-sized companies that may not have a lot of in-house climate reporting or social reporting expertise, trying to find a natural middle ground between the overwhelming amount of data that investors are increasingly asking for in terms of ESG performance and the bare minimum or the legal maximum that they're permitted to disclose on the company side. So trying to find the happy medium there. NASDAQ has taken a position that ESG transparency is a vital lever in the capital markets. That kind of decision-making power is absolutely meaningful and correlated to other advantages for a listed company and for an investor, frankly, over the long-term performance of their portfolios. So we're in the business of trying to create more transparency and awareness around sustainability and sustainability data. But also, as you probably know, and as your audience knows, in a largely unregulated environment in the US. Not necessarily the case in the rest of the world, but here we work on voluntary initiatives. And so a lot of my time is spent patiently making the business case for ESG transparency to stakeholders that may or may not be totally down.
No, I get that. And we see a lot of that with respect to, I worked in the insurance industry, and a lot of insurance carriers are adopting ESG standards. They've actually tied their CEOs' bonuses, executive bonuses, to ESG standards, which I think is absolutely huge because that means you have skin in the game. I love the fact you're helping smaller companies because they will not have those resources. And these are very specialized knowledge. It's a specialized knowledge that not many people will have or understand. And that's where the key is for me is people think environment, they think trees and flowers and birds and yay. It's not entirely that. It's pollution. It's what you're investing in. It's mining. Everyone's, mining is a big issue. Who would you say of all the industries you're working with has adapted and grasped onto it the best?
Well, in terms of climate, you can't argue that some of the technology companies are out in front in a couple of different ways, and not just because a preponderance of them list on NASDAQ, but they are used to data-driven decision making. So they've been looking at data signals in an innovative way for a generation or more. The managers just tend to look at dashboards. They want more information as they make decisions about the operation of the company. So it's not importing a strange management culture into a corporation. It's really sort of growing from within. These are people that started these businesses from a data-centric perspective, and they want these kinds of informational cues as they manage the business. So I think that there's been tremendous work there, and even a lot of in a highly competitive industry, a lot of cooperation there in terms of setting industry standards and best practices, working on things like conflict minerals and getting those things out of the supply chain. So there's been a fair amount of cooperation in that competitive space. I can't really address the oil and gas and mining sector. We don't list too many of those companies. Obviously, they have their own struggles in this space in terms of transparency and climate responsibility. Yes. But we find that there's a certain consumer-facing brands certainly have a story to tell around their climate responsibility, and increasingly not only pleasing a diverse stakeholder audience that includes their customers and their clients, but even their internal stakeholders, their employees, their future employees. So yeah. Your reputation, your standing, and your authenticity on something like climate awareness and climate transparency absolutely is a talent differentiator as these companies grow.
Do you think it's growing more so internally, or is it more so outward facing right now? Are companies really focusing on the employee experience, i.e. working in green buildings, or even things like moving their fleets over to zero emission vehicles for deliveries and that type of stuff? Where are you seeing more of a dramatic shift?
The shift in the pressure up until the last 16 months was clearly on the infrastructure side. So how you manage energy costs, the efficiency of your fleet, your own energy consumption, trying to green your supply when it comes to energy consumption, moving away from offsets towards more of a net zero approach. That was obviously in motion. But then the lockdown and the pandemic has totally upended our suppositions around workplace and around how we handle things like health and safety and employee commitment to physical working spaces when they're not in the physical working space of the company itself. So if you're going to calculate scope 3, for example, now do we have to go outside of the company itself to look at the individual employees' contribution to emissions in their home? So a lot of we've had a disruption in the sort of calculation in terms of just climate. There's a social component to this too, which has been tremendously disruptive over the last year and a half. But just in terms of climate, we've had to rethink a lot of assumptions about how companies tabulate their emissions and their energy profile over the short and long term because of the situation that we're in. So we've got this accelerating climate crisis that is there in the background and creating this drumbeat of participation, enforced participation and transparency. But then we also have these short-term dynamics that force us to rethink how we measure some of these performance metrics in a meaningful way. Just putting an emissions number out there is a different process now than it was a year and a half ago.
That's very true. One of the things I wanted to bring up was what you said earlier is Europe is much more advanced in reporting than we are. We kind of have been a little passive. We haven't made it mandatory like other countries. People do like to keep their internal information internal. They don't like to share these things. Do you see that changing? What do you think is the pathway towards full transparency and more companies adopting ESG standards and kind of getting on board with things?
You're right that the U.S. has been absent a lot of that regulatory scrutiny for a long time. This has been happening in the rest of the world, especially in the EU. So the fact that they are more advanced or they're further ahead than us is often driven by a lot of direct government intervention and the power of pension funds and institutions to drive mandatory investment in green vehicles. So things are happening that are required around the world that are sort of accelerating that viewpoint and that sophistication on climate as an investment factor. But of course it's coming here. We've got lots of signals from the SEC that they're going to look at least at climate and maybe other ESG reporting practices in terms of US companies. But I think that, there's a couple of issues that are coming to the fore. One is this idea that I talked about earlier, the business case has become more accepted. So the idea that this is not a bolt-on, this is not a public relations maneuver, this is not something that helps your company look good in terms of its PR externally, which is where the thinking was maybe 10 years ago in this country, to this being sort of fundamental to the operation of the company. When you talk about your ability to manufacture products using a supply chain that will be absent in 10 years, or the cost of your energy going up 3 or 4 times in the next 5 years, and you just can't compete on those margins. These are now fundamental levers that managers are looking at that actually help them differentiate between the sort of climate-related investment or ESG-related investment that is meaningful and the ones that are just sort of marketing. And I think that you're seeing that transition has definitely accelerated the pace of acceptance of this idea as a modern management technique. The other part is we've got this huge, massive explosion in market demand, from the investors and others for green products, ESG products. I know we'll talk a little bit about greenwashing, but I mean, you've got this seemingly unquenchable thirst for products that are going to, at least on paper, move my capital in more sustainable directions, into more responsible categories, into more sustainable returns too. And there's an increasing awareness in all of the capital markets that ESG is a fundamental part of that analysis.
One of the things, talking about ESG and fundamental analyses, I know that everybody lately is investing in this, and I know that it's created sort of a gigantic bubble of investments. Do you see that flattening out or becoming a little more manageable? Because as you said, everyone was jumping in, and of course, people are probably not going to be the most honest with their reporting on certain things. Maybe they'll just check the boxes, or maybe they don't have the training to properly check the boxes. Do you see this kind of being flattened out, or do you see a bubble bursting? I mean, it's a little fearful, because I do want to invest more in green investments, but I'm also fearful about it.
I don't see it bursting. I see it growing. I mean, depending on who you talk to, and this is related to the greenwashing piece, it's a $40 trillion market, which is about a third of every investable dollar in the world. I mean, it's a significant proportion, potentially, depending on how you define things, of the analysis that ESG writ large sort of fits into this space. So I don't see it as a bubble that will implode. I see it as a technique where investors in particular are trying to figure out where the correlations of value are. In the world of ESG, we have hundreds of metrics. We have dozens of reputable frameworks that are looking at very specific KPIs. Which of those are actually tied to corporate performance over the long term? Which of those are actually returning signals of value? And which of them are just meaningful, especially if you have a particular impact interest, or you're looking to create a certain agenda? That might be a meaningful metric for you, but it doesn't contribute to the overall valuation of the company and sustainability of its operation over time. So I think that investors and others are trying to figure out where those signals are really meaningful. So can we boil that list of 1,000 metrics down to a few hundred? Can we boil it down to a few dozen? Nasdaq saw this problem early on, and we heard from our list of companies that they were having all kinds of trouble navigating the different frameworks and the requests for information, which are just overwhelming, especially small and medium companies like we talked about before. So we created this ESG reporting guide that basically looked at all the frameworks and tried to find the common denominators between all of them, tried to make a business case for each of them. And we got the list down to 30 across the E, S, and G space, 10 from each. Basically said for companies that are starting from scratch, that have no idea how to navigate this space, start to measure and manage this stuff in-house, and then think about making it public. You'll be as skilled at this as 90% of the companies if you just handle these 30 metrics. So when companies come to me and they say, it's an impossible task, the learning curve is too great, the resource burden is too heavy, I think you can actually get to competence rather quickly. I think you can get to meaningful disclosure without a tremendous disruption to your culture or to your commitment to transparency. How do we go from that to excellence? How do we go from that to actually fixing things that are meaningful in terms of climate? It's another question, but we need to start somewhere.
Very true. I mean, when you talked about the reporting, just so everybody who's listening in knows, there are a multitude of reporting companies, GRI, SASB, TCFD, there's several, and they all have their requirements. They all have different things depending on the industry you're in and how it affects. So I love the fact that NASDAQ came out with a checklist of 30, because it can be overwhelming, especially someone who doesn't have the environmental background that's now looking at something that's completely and utterly foreign to them. So that's great that you guys are doing that, because that helps people with their learning curve. I am going to put Joy on the spot, because I know with her financial background and also government, talking about regulation, you're in the forefront of all of these things. So Joy, what do you see happening with regulation, pushing it forward, getting people to adapt?
Well, it comes down to funding, right? So I think that a lot of the private companies, as they figure out which way they're going to move to get to some of these regulatory goals, such as 2035 zero emissions in California, it really takes, what does that look like, right? A lot of the regulating bodies are not putting out the funding because they don't have the funding themselves to initiate and incentivize programs. I get a lot of people that ask me, especially like in South LA and various areas, that might be mom and pop businesses. How do we convert from our old clunky F-150 truck to a zero emission truck? Yeah, it's a costly proposition. They have to set up infrastructure to be able to charge the vehicle. They have to be able to manage the time frames in which those vehicles can be used. And most importantly, they have to figure out how to financially fund it when they could just change the muffler or the oil on their old gas guzzler and just keep moving and moving products. So I think the same things that are affecting like the larger companies are hitting even the smaller guys that want to eventually be on a Nasdaq or some publicly traded company, it's really creating such a gap that people aren't able to make those types of leaps that they need to in order to get their business up to a level. And then companies that, that Evan represents, they're doing the best that they can, but they're not getting the information they need from regulatory bodies about where regulation is going. So it's kind of a catch-22 for everybody. People want to be green. People want to be sustainable, even if they have their employees work at home. But it's just a hard proposition of the chicken and the egg. What's going to come first?
It's also
What do you think,
of it.
Evan?
It's the cost. I mean, it does come down to
It's
cost.
the cost.
Yeah, and the willingness to make investments. I mean, Joy identifies a central tension in this work, which is the market has short-term demands. The market wants the company perform to meet all its targets and its estimates for the quarter, and yet a company also needs to invest sometimes a significant amount of money into sort of greening their operation and making it more resilient over the long term. Some ESG investments, like I said, some ESG projects are easy. Some are sort of don't require a heavy lift. Some absolutely do. If you're going to rethink your energy portfolio and you're a heavy manufacturer, that's a significant change to the direction of your business, and it requires a significant investment. And if you don't have investors in particular that are willing to go along for the ride, the market could punish you artificially for thinking so long term. And so there's a fundamental tension here between making your operation more resilient and sustainable over the long term, and also trying to placate those forces that actually drive your operation through providing capital.
Wow. So one of the things you mentioned earlier, which I wanted to kind of go back to, was companies are going to have to rethink how they do business. So for me, being the environmental pollution person, I'm always thinking climate change, sea levels rising, how you get your materials, where you get your materials. That's all going to change, and people have to adapt to that. But what Joy brought up, which dummy me didn't even think about, entire small companies are going to have to refurbish their fleets because there will be shortly a mandate, and that affordability. And I know Joel and I have talked extensively about lithium batteries and mining of lithium batteries in the Salton Sea. That's a touch point for all of us. Joel, did you have anything to add on the fleet side of things? Because I know you know people in that industry. No.
Did you say her or me? I'm sorry,
I said Joel.
Oh, no, sorry. Sorry. I think it's just a matter, it's going to come down to the money. I think it always begins and ends with the money. It's how do you invest it? And like Evan was saying, you have to have the capital to invest in the first place, but then you also got to make sure that the people that you have to placate are getting their money as well. So that way they don't abandon you. So at the end of the day, it's always about the dollar. It just is, unfortunately. That sounds terrible to say, but it's true.
But it's the truth.
And do you think that where do you think the balances should lie as far as regulatory, which is very costly for large companies and small companies to kind of be able to navigate? Should it be the industry itself pushing the bottom line with the dollar when they, in fact, have employees that they have to pay as well? And things to keep companies afloat. It's like everybody's passing the buck around, including, the government and, public-private partnerships. It's something that's been talked about for decades. Certainly not happening because everybody's like, well, you put in $1, I'll put in $1. Everybody kind of wants to play that like cat and mouse game. And in the end, it doesn't seem to be, balancing out. Who do you think should be kind of responsible for taking the first steps, government or private industry?
Personally, I think industry is the one that's leading the way right now. I mean, look at what's happening in California when you've got the auto industry stepping up to say, we're going to do this. And then all of a sudden, once they decided we're going to start getting rid of going to an all electric fleet, now you've got all the other states that are signing on board to tighten up their deadlines to go even further. So I think, unfortunately, it will start with industry changing before the government will. The government has too many other outside influences in it to really spearhead this.
How do you mean?
What's that?
How do you mean, Joel?
Right. I mean, it's like, okay, look at what's happening right now on the East Coast. The East Coast is running out of gas because the pipeline is shut down. So this is, it's going to take 2 weeks. Once the pipeline gets back up and running, it's going to take 2 weeks before the gas hits New York State again. 2 weeks. Like some areas in the Southeast are already running out of gas. So, we're already showing, you had the water issue that happened where they were hacked into earlier this year. And then you got this one, which was a hack in as well. So we have these major infrastructure things that are being controlled in one centralized location. So it's kind of, not to say that if this goes green, you got the solar, you got the windmill plants, that they can't be hacked in as well, but you're probably going to have various hubs, which may be a little bit harder to get into. So it's about looking at the situations that we've created and how we go forward with it. And I'm totally just going all over the place here. This is also going to be a generational thing, because the generations before us, like, that's fine. I get like 4 miles to a gallon on my 7,000 pound Buick or whatever my car was. No offense to any manufacturer, but it wasn't a big deal. So, then we have the catalytic converters come in. And so it's like, these are all generational changes that occur. And as the next generation comes up and they're getting more vocal about what's happening to our environment, the industries are going to react, because they're realizing they don't have a choice. If they want to stay afloat and have any consumer whatsoever, they're going to have to adapt to this next generation. And it's just going to keep going and going. It's just, we've kind of let it go too long to get to this point. Sorry. That was a total roundabout way to get to that.
It was, but it was awesome. And I'm going to let Evan respond also to Joy's question about industry or regulation. Chicken before egg.
Well, knowing who I am and where I come from, of course, I'm a free market supporter. I think that this is going to be driven by the marketplace. I think it always is. I would love to say that regulation front runs trends and actually helps create opportunity and shields us from risk before it happens, but it tends to work the other way. It tends to come along well after. So I think the market forces have been driving a lot of voluntary engagement, innovation, a lot of real development in this space and capital investment in this space long before the regulators have compelled them to do so. So I think that I always think that the market will help to try to push things in the right direction, because, and it's what Joel just pointed out, the alternative is extinction. The alternative is there is no business, so there is no widget, there is no material, there is no fuel. There's no customer or no meaningful customer at whatever price you have to sell your thing for. So once you put things in those kinds of terms, when you think about it as 0 or 1, this is how we survive, this is how we don't, it becomes pretty obvious where the market needs to go. And, it's pretty amazing to me that we've had this much innovation and development on transparency in a voluntary space without a price on carbon, effectively, without a lot of direct regulation in some of the largest market spaces, with the continued profitability of fossils and other things that are, may not be, as productive over the long term, even if you think about them as transition energies. So, the fact that the market has performed as well as it has and seems to be generally lurching in the right direction, even if not big enough and fast enough, is pretty remarkable defense of that market-based analysis.
And I do believe the oil and gas industry is recognizing the fact they need to change. Most of the larger corporations do have quite a strong initiative to, focus on electric, focus on hydrogen. Hydrogen, I think, is a great product if you can do it green. And it can be stored indefinitely. Electric, we have to find more lithium. We have to find a way to do a battery without cobalt. There's a lot to consider. But as a closing for this meeting, any words of wisdom, as Evan, on businesses and how they can do their ESG reporting, or who can they look towards for help, guidance, guide them towards Nasdaq's 30-point list?
I would actually. I think it's a fair place to start. It's a readable document. It's only 20 or 30 pages, and it actually lays out the business case for all of those metrics. And I think that it also talks a little bit about some of the lenses for doing reporting, like materiality. Companies should be customizing any of these lists. They should be looking at reporting frameworks and thinking it through how it's appropriate or inappropriate to disclose certain things based on their business. If I'm a sneaker manufacturer, the health and safety of my workers on the factory floor is much more relevant than if I'm a completely digital company and I have no physical workers on the factory floor. So think things through in terms of what your business is and where your risks and opportunities are, and disclose to those metrics. And the other thing that I counsel listed companies on all the time and have for years, which is you should be measuring this stuff in-house long before you talk about public disclosure, engaging with a framework, engaging with an investor, putting a report out, trying to compete for one of these indexes or best of lists. All this information should be in-house, and you should be managing to it, because it's absolutely an indicator of risk and opportunity for the future of the business, no matter what business you're in. And you're going to be punished by the marketplace for not having this expertise, at least in-house, whether or not you talk about it publicly or not.
And also crossing silos. So, you know, we've all had the corporate background and everyone kind of keeps in their little silo and they don't talk to each other. ESG, you have to be able to talk to everybody. You have to have full access, including diversity, equity, and inclusion. In my opinion, part of the social responsibility is DEI. If you cannot have everybody be in a comfortable, happy workplace, you're kind of failing on the ESG aspect as well. So on that, I will let Joy and Joel have their last words, and then we can close out.
Oh, no, thank you. It's just an honor, Evan, to meet you and, you know, talk to you about which ways both policy and private companies can kind of get together to figure this out. If we're going to stick to the, you know, timelines that we say we're going to stick to as far as getting to net zero. It's really going to take more cooperation and more group efforts of one following the other in order to make some of this change happen. So great to know you.
Excellent.
I'm going to just mirror exactly what she said. I think this was a great chat. It was good to hear it from your side of it, because we've spoken to a lot of direct people at once. It was nice to hear something from the Nasdaq side about the economics of the whole situation, which was great.
Which is complicated.
No, it's not. It's easy.
Yeah.
We can do this.
Yeah, I'm the geologist in the group. I stick to my dirt and rocks. I'm happy where I am.
But Tuesday, we'll be all good.
I'm sorry?
It'll be figured out by Tuesday. We're good.
It'll be figured out by Tuesday. But Evan, thank you so much. This has been an absolute pleasure for all of us. The knowledge you've shared with us, that I will post also in the write-up, Nasdaq's 30-point guide. This is amazing. What you guys are doing really helps, especially the small businesses, the medium-sized businesses who just are struggling. So thank you for that.
Thanks for having me. The half hour flew by. It was a good conversation.
It does fly by very quickly, I have to admit. So thank you all. You all have a wonderful day, and we will see you next time. So remember, no shaming, no blaming, and every little bit helps.
Bye.